My name is David Jaffe. Welcome to the Wealth and Health Podcast, where you'll learn valuable skills and positive habits that will improve your life. This podcast originally aired as a video on my YouTube channel at youtube.com/BestStockStrategy. The Wealth and Health Podcast is brought to you by BestStockStrategy.com. Options trading, the best and ultimate guide. In this video, you're going to learn how to trade options and win up to 98% of your trades. Let's get started. The first thing you need to do is you need to sell options. The reason is that when you sell options, you put the probability in your favor. When you sell options, you turn yourself into a casino and you also act as an insurance company. When you buy options, that's a low probability trade. Now, when you win, you have the ability to win more money. The reason why we sell options is that it provides you with the ability to have a very high win rate. Every time you sell options, your expected probability of profit is over 50%. In fact, if you choose your strike prices correctly, then you can oftentimes win over 95% of your trades. The next thing you need to do is to develop a watch list. We have stocks such as Amazon, Tesla, PayPal, MasterCard, and JP Morgan. The reason why we choose these stocks is that they are market leaders and they're also very strong brands. Additionally, because the market caps on these stocks are so high, Amazon has about a $2 trillion market cap. Tesla, I believe, is about a $500 or $600 billion company. With these type of stocks, you don't have to spend any time researching them because all of the existing information is already priced into the current market price of the stock. The next thing you need to do is get comfortable with the recent trading range of that underlying stock. When I say recent, I'm referring to where has this stock been trading over the past 2 to 3 weeks up to the past 3 months. Now, the more recent the trading range, the more important it is in factoring into your decision. For example, as of September 14th, 2021, the recent trading range for Amazon is about 3,200 to about 3,500. As a result, right now, because it's trading at about $3,450, that means that Amazon is trading at the higher end of its recent trading range. Now, because the 52-week high was about 3 to 4 months ago, you want to give more weight to the recent trading range. Tesla, its recent trading range is about $650 to about $720. Once you're familiar with the recent trading range of all the stocks on your watch list, you're then going to make a decision on whether you want to sell a put or sell a call. You're going to sell a put if you believe that the underlying stock is oversold. So for example, because Amazon's recent trading range is about 3,200 to 3,500, if Amazon trades to about 3,350, at that time, I'm going to consider selling a $2,800 put option on Amazon with an expiration of about 4 to 5 weeks out. By selling a put option that expires in about 4 to 5 weeks and also having Amazon be about 10 to 12% below its 52-week high and also at the low end of its trading range, that will give me the adequate comfort and safety net to make sure that even if there is a large pullback in the market, then my position will be okay. So by selling a put option on Amazon with a strike price of about $2,700 or $2,800, when Amazon is trading below $3,350, that should enable me to collect anywhere from about $8 to $11 a premium, depending upon the implied volatility in Amazon and also the overall volatility in the marketplace. If Amazon begins to trade above 3,500, at that time, I will sell a call option with a strike price of about 4,000 or 4,100 with an expiration of about 4 weeks out. Selling that call option will allow me to collect about $6 to $8 per share or $600 to $800 for every contract that I sell. Once you make a determination whether you're going to sell a put or you're going to sell a call. Now remember, you're going to sell a put if you believe that a specific stock on your watch list is oversold. You're going to sell a call if you believe that a specific stock on your watch list is overbought. At that time, you're going to sell an expiration of about 4 to 5 weeks out, and you're also going to look at the available premium on that specific strike. If that amount of premium is acceptable to you, and you ask yourself, am I receiving enough premium to compensate me for my perception of the risk that I'm taking, then you should make that trade. So again, if you believe that a stock is oversold, then you'll sell a put option. You'll go about 10 to 15% below the current market price of that specific underlying. You'll sell a put option that expires in about 4 to 5 weeks, and then you'll look at the available premium and ask yourself, are you receiving enough premium and enough money to compensate you for the perception of the risk that you're taking? If you believe that a stock is overbought, you will then sell a call option and you'll collect money and collect premium for making that trade as well. The next thing that you want to consider is the VIX and the implied volatility and the IVR on that specific underlying. The reason you want to take this into account is that the VIX and the VVIX measure the respective fear and the panic that is present in the overall market. You don't want to enter a position only to then see the VIX and the VVIX rapidly expand immediately after you enter a new position. Because once you enter a new position, you're already committed. As a result, the best thing that you can do is to sell option premium during periods of high implied volatility and during periods when the VIX and the VVIX are relatively high. VIX over 20 means that you're going to collect a substantial amount of premium. When the VIX is below 20, then that means that you have to be more careful because you don't want to open up a new position only to then have that position show you a loss if the market pulls back in the near future. You want to be familiar with VIX and VVIX because once you open up a trade, you're already committed. And you don't want to have the VIX and the VVIX expand and have the market pull back immediately after you enter a new position. Because if that happens, then the position that you just entered into is going to end up showing you a loss. What I like to do with VIX and VVIX is when the VIX is trading over 20, I will always sell naked options. When VIX is below 20, then I will definitely consider selling a spread. However, my portfolio uses portfolio margin, which means that it doesn't use up a significant amount of buying power. As a result, when the VIX is trading below 20, I'll usually go farther out in my strike selection and I'll still sell naked. But I would recommend that if you're using regulation T or regular margin, then when the VIX is trading below 20, you can sell vertical credit spreads. And then when the VIX is trading above 20, then you can sell naked options. Remember that the most important thing that you can do when trading is to make sure that you don't trade too large. The reason why people say that selling options is risky is that options are a leveraged product. And you don't want to sell too many contracts only to then see the market go against you and have you be forced to close out that position for a substantial loss. It's much better for you to target earning around 3% every single month and trade very small and leave about 40 or 50% of your account as cash available to withdraw. That way, that safety net is going to allow you to ride out the pullbacks when the market decides to correct and when your positions go against you. The worst thing that you can possibly do is trade 80 to 90% of your account and then have the market simply pull back by 2 or 3%, and you'll be forced to close out the position for a loss, only to then see the market resume its uptrend and your original positions would have shown you a profit, but because you traded too large, you were forced to close out that position for a loss. So again, the most important thing is to make sure that you size your trades correctly. I know that this was a really quick rundown on how to trade options successfully, but I definitely believe that it's important to keep things as simple as possible. I do not read any articles on seekingalpha.com. I do not watch CNBC. I do not consume or watch videos about the stocks that I'm trading. Instead, I only focus on the price action and ask myself whether I believe I'm collecting enough premium to compensate me for my perception of the risk that I'm taking. One of the most important things is to make sure that you recognize that nuance, discipline, and experience is going to help you become a successful trader. Nuance, discipline, and experience is going to help you make better decisions. And that is the name of the game. You are not going to get paid for reading articles and competing with other investors based upon knowledge. You are competing with hedge funds and high frequency trading firms. And there's no way that you can possibly know more about a company than they do. The best way that you can be consistently profitable is to increase your experience and make good decisions. You will learn when to make a trade and when not to trade. By improving your discipline and gaining experience, you'll be able to know when to trade and when not to trade. If you want to follow my trades, you can go to beststockstrategy.com/memberships. It's only $19 for 7 days. You can also take my options trading education course. That's also available at beststockstrategy.com/memberships. The options trading alerts will allow you to follow my trades, and it'll also give you insight into my thought processes about why I make a specific trade and why I don't make trades. Remember, if you want to be a consistently profitable trader and win up to 98% of your trades, you're going to have to make good decisions and you're going to have to learn from experience. So why not look over my shoulder and take the trade alerts or take the options trading education course, so that way it will help you avoid making costly and expensive errors, which may end up costing you a lot of money. David Jaffe with BestStockStrategy.com. You can visit BestStockStrategy.com, enter in your email address, and receive over $400 of valuable free training. Please leave a comment below and let me know your thoughts on what the best options trading strategy is. Visit BestStockStrategy.com and submit your email address to receive valuable free training. Please give this podcast a positive rating and review. If you have any questions, visit beststockstrategy.com and send me a message.